Welcome back. Welcome back to the retail banking analytics section. In this session, we are going to cover the basics of banking. In the last session, we covered some of the finance concepts: present value, future value, cash flow, rate of return, internal rate of return, discount rate, interest rate, so forth. And again, when we talk about those rate of return or IRR, internal rate of return, the word return comes because you invest, and after some time the invested money is returned back along with profit or the interest component. Because the money is coming back, that's why it is a return, and the rate at which you got extra money is rate of return. So those things we saw. Now we'll now get into the banking. What is banking? Let's try to understand this very basic concept. What is banking? Banking is a system of trading or engaging in monetary transactions. Leave aside the emotional quotient part and customer relationship management and other aspect. If you see at the core, banking is all about monetary transaction. You have money which is in cash, you got liquid money, you put it in a bank, that is deposit. You do not have money, but you want money, you borrow money from a bank, that is a loan. You want to make payment to someone, you transfer money from your account to the other person's account, that is a transaction. So banking is basically engaging in monetary transaction where either you deposit, you withdraw, you transfer to someone else, or you take loan from bank. All these are monetary, and the intent of facilitating these transaction through an organized structure, through an organized organization, which is bank in this case, is to ensure safety when you do transaction, safeguarding the money of depositors who are saving their excess funds with the bank, and banks make that excess fund of depositors on the other hand available to someone who is in need of fund, that is the borrowers. So if you see, three main entities are involved in the banking. One is a depositor, second is a bank, and third is a borrower. Let's see the characteristics. Depositor is someone who deposits his or her or its saving. Depositor can be any entity, it can be a human entity, it can be an organization. Why we deposit our money with bank? First and foremost, safety. Second, it facilitates transaction with various parties. Third, it gives us the flexibility to withdraw money as and when we need. Fourth, on that money we get an interest. Along with that, there are many other services which a bank provides to us. So that's the reason why, as a depositor, we need banking services. The other extreme is a borrower, a person who borrows money, who is cash starved. Borrower makes money, a borrower borrows money from bank for either a personal reason or for a business reason. Personal reason can be home renovation, education of child, marriage in family. Business reasons can be want to start up a business, want to expand the business, want cash available because my cash flow is irregular, but certain payouts are regular. My money from my parties, counterparties, which is the people to whom I am selling my goods and services, that money is not regular. But the employees to whom I have to make money payment is a regular monthly salary. So balance my cash flow also is a reason for which I may need money, right? So when a borrower borrows money, there is a certain rate of interest which a bank charges. And the borrower promises to repay the principal amount along with interest component and any other dues, any other charges. The various reasons I already mentioned. And sometimes when you borrow money, you may have to provide a collateral because of the risk associated at time of lending. So there may be a collateral, there may not be a collateral. Collateral is simply put a security which is given by the borrower to the bank. And between the depositor and the borrower, we have this bank which facilitates transactions and availability of funds between depositor and borrowers. Various services provided by banks are they accept deposits, they lend loans, money, they provide safety and availability of funds to depositors, facilitates transaction between buyer and seller, and many other services like bill pay, auto pay, those kind of ATMs, point of sale transactions. So many others such services they provide. If you see traditionally there has been three main entities which have been providing the financial services. One is the bank, the most organized sector. Then we have got NBFCs which are again organized. And third is basically money lenders. With time, the role of money lenders is shrinking. But at one point of time in history, when NBFCs were not there and banks were not had not percolated to every corner of the country, in that case, the gap, the void which was left by banks was overcome or facilitated by money lenders. So typically speaking, banks and NBFCs are legal and organized institutes Whereas NBFCs are individuals, and most of the time they do not have a legal sanctity. They, at their own risk, they carry out the business of lending. Activities: a bank accepts deposits and lends money, which means if you want to open a deposit account, which is a current account or a saving account, you can go ahead and open an account with a bank. However, NBFCs only lend money. They cannot take deposits. The way they take deposits are in form of corporate bonds, or they take deposits in form of fixed deposits, which typically are bonds, where they take that money for a particular time period and promise to pay the money at a later date. They do not facilitate payment and settlement services. Banks are facilitating payment and settlement services. However, in recent time, we have got a new set of NBFC which are called payment banks. Of late, we have got a new kind of a NBFC. Earlier, when RBI regulations were not very open, we had NBFCs which were facilitating the business of lending loans, but they were not supposed to do payment and settlement services. However, of late, we have got a new kind of an entity coming up which is called as payment banks. What are these payment banks doing? They have all sorts of wallets. They have wallets, e-wallets, where I can put a small amount and transfer that amount to someone else. So of late, we have got many payment banks which have come up. Oxygen, Paytm, then we have got Phone Pay. All of this, the way they facilitate is you put cash, you transfer money or load money in your wallet, and then transfer money to someone else. From a government point of view, we have got apps called UPI and Bhim Pay. And the reason of facilitating these kind of payments are when you make a small ticket transaction. For example, you are buying something from a roadside shop. While buying something from a roadside shop, you want to make a payment. Now, asking to that person, give me your bank account number, give me your bank details, then you will register that, and then you will transfer money. It's a hell lot of a task. In that case, the simple approach would be, give me your mobile number. I have my mobile number. If you're on the same payment wallet, e-wallet, you simply take mobile number and transfer money. It becomes very easy. So a new kind of NBFC, which is the payment banks, has come up, right? Money lenders typically are entities which lend money. They may also accept funds, but in that case, depositors may not be very assured whether they will get their money back. Because traditionally, what has happened is there are many people in villages who, because they did not know how to go doing banking, they felt going to a money lender or which we typically call as a jamidar, going to that person, giving and then taking back money as and when required would be safe, because in their own small hutment they feel it risky to keep that money. So banks are typically more for the organized sector, and they cater to clients which have got proper KYC details, and deposits anyone can open. But still, we saw huge amount of a huge amount of people did not have accounts till a time when Jan Dhan Yojana started. And after Jan Dhan Yojana started, we saw all of a sudden banks got 2 crore, 3 crore more customers. One of the thing is because many people who are poor and illiterate, they feel banking is difficult. So overall, reason for low penetration is low literacy level and hesitation of a individual to go and speak to people in the organization banks. On the contrary, if you see in India, we have got more SIM cards than population of India, and it is well penetrated. But banking, which also should have been well penetrated, is highly underpenetrated. This left a huge gap, which is then overcome by the NBFCs, the payment banks, and the money lenders. So, where is the payment bank coming up? Let's take a simple example to understand that. Oxygen Wallet. What you can do is you can go to Oxygen Wallet, simply give your mobile number. Now, RBI has put Reserve Bank of India, which is the central bank of India governing the regulatory guidelines. Now they have started putting up KYC norms. But earlier, to open a wallet and do a transaction till rupees 10,000 within that limit, you simply have to go to the Oxygen Wallet kind of a counter, give your mobile number, you will get a OTP, and your wallet is ready. And at the counter, you have say 500,000 rupees. You want to put it in that wallet. You give that 500,000 rupees and you want to transfer it to someone. You give the mobile number of the person to whom you want to transfer. That person will do the transaction. Money is transferred to the other person. The other person can go and collect the cash from the Oxygen Wallet franchisee or the shop which is at the other end. The reason this is so easy, which is the illiterate community feel, is because here you are interacting with a person. That is one. Secondly, these kind of payment counters are put at locations where there are such kind of people. So it becomes easy for them to transact. And the benefit of this is no charges or very low charges. For example, banks unwantedly created a system wherein if you do deposit in other branch, you are charged rupees 100. Now a poor person, he has to make a transaction of 500, deposit to send it to someone else. And for that, in case he lands up in a branch which is other than the home branch and 100 rupees deducted, what will the poor person do? So this is all reasons why the payment banks, one of the major reason why payment banks has increasingly gained popularity. NBFCs has gained popularity because banks typically do not cater to the lower segment of the strata. In that lower segment of the strata, the risk of getting your money, the money that you are lending, getting the return of that principal amount itself is questionable. So that segment which was left with the banking industry is captured by the NBFC industry. There are again many reasons. Banks are were highly guided by regulatory norms. As a result, they could not charge interest rate 18, 20, above that. They could not go and charge 30% obscene interest rate. They could not. But when you're lending in the lower strata, your risk of getting the principal amount itself is very high. To overcome that defaults, NPAs, it is important that you charge rate of interest which is 20, 25, 26 percentage, because you are expecting 8 to 10 percentage of the money that you lend may not come back to you. To prevent that loss, you have to charge higher interest rate. NBFCs took benefit of that and they started giving loans at a higher rate of interest. Okay. Client profile, if you see, banks cater to, from the loan point of view, bank caters to a profile which is low risk. NBFCs cater to high risk. Money lenders, high risk as well as financial illiterate. High risk as well as financial illiterate people. Types of loans, they provide secured, unsecured, both. Again, NBFCs provide secured, unsecured. Money lenders also provide secured, unsecured. However, most of the time you will see money lenders' loan are secured. Okay, because they typically take gold, silver as or land as a security. Recovery of dues is all governed and regulated by Fair Practice Code as laid down by RBI. Once upon a time, NBFCs were not that regulated. However, now they are under regulation of RBI. In money lenders, there is no governance because it's a unorganized sector, and recovery process may sometime become strict and inhuman. Lending rate typically governed by RBI and competition in market, generally lower than the NBFCs. Lots of regulations have come up for NBFCs. They also of late cannot charge beyond 28, 29 percentage. Okay. However, still their rate of interest are very low, high compared to banks. Money lenders' rate of interest is extremely high. It can be as good as 50%, 80% also. Now, the good one thing to understand is banks get deposit, which means the low cost of funds. NBFCs has to raise deposit through bonds, fixed deposits, when they call public to give money as investment in fixed deposits or bonds at a higher rate of interest. Banks typically pay 4 to 6 percentage on the savings account, and NBFCs typically raise money from 8 to 11 percentage in current market scenario is what I'm saying. So if you see, the cost of funds for bank is too low, whereas the cost of funds for NBFC is high. That is point one. Second is, banks do not cater to high risk, but regulatory norm says that you have to cater to all segment, and the segment which typically banks avoid because they are high risk, that is called as a priority segment. Priority segment is the segment which RBI has laid down that, hey, you need to give this much amount of money to this segment. That priority segment can be small lending businesses. That priority segment can be education loan, because small businesses you have to promote, right? So you have to give to them. There will be some segment which is like a unemployed, not unemployed, self-employed but illiterate people. For example, a roadside tea vendor, right? He's illiterate but still running a business. And if he or she asks for loan, you have to give. Agriculture is a huge segment, right? You have to give loans for the farmers so that they can buy uh, a cow, a goat. Even for buying animals, they have need a loan. To buy the seed, they require loan. These are all priority segment. Some of the priority segment banks directly lend. However, some of the priority segment, they do not have the wherewithal to reach to that segment, and they do not have the wherewithal to evaluate the risk of that segment. In that case, what happens is NBFCs again come into picture. What NBFCs do, because they have set up their infrastructure in those specific areas and they have developed their own expertise in that domain. Small finance banks, basically. So they typically develop that expertise. So they end up giving loan. Now, assume there is a bank which has to ensure 10% of their total lending has to be from priority sector. But unfortunately, I as a bank do not have expertise to manage that exposure. There is some NBFC which has got the expertise. So typically what bank will do, bank will allow the NBFC to do the lending. NBFC will build a book of say 100 crore. After having built a book of 100 crore, NBFC is going to sell it to the bank. And NBFC is going to maintain that book. The entire recovery process will be managed by NBFC, but they will build a book and then sell that book. When I say book, here you have to understand it's a portfolio. Book is a term used for portfolio. So they develop the book and they sell that portfolio to a bank which is short of meeting the priority sector lending norms. And that's how also they make money. This is called securitization. This is called securitization. Okay. So these are all related to high level information on banks, NBFCs, payment banks, and money lenders. Understanding this bigger picture is very important as you develop your knowledge domain in this area. I would suggest that I have covered at a very high level, and this market scenario is changing very fast. Based on this initial introductory level, you should now start getting more information as a comparison between these players. And one of the important thing that you should start understanding is how payment banks are functioning. I leave that as a homework for yourself. How payment banks function. What is the payment and settlement process followed by these payment banks? In current economic scenario, most of the payment banks are making loss. How they intend to become profitable in the long run? Because when these many payment banks are mushrooming and when they are putting their capital, probably they will have some plan to make money. In current scenario, if I see, most of the payment banks, according to me, will end up making loss because the way the electronic transaction is evolving and the way the banks themselves are becoming payment and settlement service provider through their own e-wallets. Soon, most of the payment banks which are mushroomed may have to close business except a few which are big ones who are leading the race. Otherwise, many of them will end up shutting the shop. But it's a very good element to understand. So I leave that as a self practice for you to develop your domain knowledge. Now, let's focus just on the banks. What are the different types of bank that we have? Okay, let's see the types of banks in India. Central bank. In India, the central bank is RBI, Reserve Bank of India. The bank which is entrusted with the function of providing regulatory framework for the banking system in the country is the central bank, and in India we call it Reserve Bank of India. Then we have got something called commercial banks, the banks that involve themselves in the business of accepting deposits and lending short-term, long-term loans to individuals and companies are commercial banks. Long back, when we were a developing country, we are still a developing country, but when industries were not much, the industrial process was just happening. There was a need that there would be specific banks which help give loans to industries and lead the development of the nation. Those were called as development banks, and their objective was to provide capital for buying land, machinery, technology, and other infrastructure things which is required. Those were called development banks. IDBI Bank and ICICI Bank were once a development bank. In this, I can also put IDFC Bank, which was also once a development bank. Now, IDBI, ICICI, IDFC, all of them have become full-fledged commercial banks. IFCI, which is Industrial Finance Corporation of India, and state financial corporations are still the development banks which are there. And increasingly, as the regulations have got eased up, many of them are trying to become full-fledged commercial banks. One of the reasons why they want to become full-fledged commercial bank is it increases the reach, it diversifies the portfolio, and by diversification you reduce the risk. When a institute is lending only to a particular segment, and if that segment in 1 year or 2 years does not perform well, what will happen is the losses will be high. Because of the high losses, the institute may make huge NPAs, may have huge NPAs, and then you will have to go back to government for rescuing them. But by becoming a full-fledged commercial bank and diversification, what happens is you mitigate the risk. At the same time, you get access to low cost deposit. As you become a full-fledged bank, when IDBI was a bank which was just supposed to give loans to institutes, ICICI was a bank which was supposed to give only to institutes. You never saw that they were taking deposits. So by opening up and becoming a full-fledged commercial bank, you get access to low cost capital also. Then we have got lots of cooperative banks, the banks that are run by cooperative societies formed by people coming together to serve their common interest. Lots of sugar cooperative banks we have. We have lots of sugar cooperative banks in Maharashtra in Sangli Satara area, right? Similarly, specific purpose banks which where people have a common interest, and to serve that common interest, they've started up with cooperatives. In Hindi or in Marathi, they also called as patpedis. Okay, and we have one more specialized bank, which is called specialized banks, where the purpose is very specific, which is like NABARD, where the objective is agriculture, National Bank for Agriculture and Rural Development, SIDBI, Small Industries Development Bank of India, EXIM, Export Import Bank. So these are specific banks where the skill is very, very niche. So we have got those kind of banks. Ideally, yeah, we are now going to focus on the commercial banks. And in commercial bank, there are two main classifications. One is retail banking, other is wholesale banking. Retail banking caters to retail customers, individuals, whereas wholesale banking is designed to serve corporates, industries, firms, those kind of entities. So retail banking and wholesale banking, and within that, in our session, we are going to focus on retail banking because that is where lots of analytics is applied. In our upcoming session, we are going to see more on retail banking, the products and services which a retail bank offers. Till then, goodbye. See you in the upcoming session. Thank you.